Hello everyone, I'm Ingwan from AllQuant. Great welcome to our channel today. Now in the investment industry, there are many jargons and terms, and a lot of these are Greek terms. And one of the more common ones you might have heard about is this term called beta. So for example, you might have heard people talking about high beta stocks, low beta stocks, or even talking about a particular portfolio saying that its returns are largely driven by beta. So what do they mean by beta over here? And this is what we're going to be looking at today. All right. So now, depending on the context of which beta is being used, it can have a somewhat varied interpretation. All right. But in the most common setting, beta is often seen as a form of relative risk measure for stocks or a portfolio of stocks. And why do I say it is a relative risk measure? Because it is always calculated against a reference market, such as the S&P 500, for example. It tells you how risky the stock or the portfolio is relative to the S&P 500. It also tells you how sensitive or how much risk exposure it has, right, to the reference market itself. All right, so let's take a look at a few examples to get a clearer picture of how beta works. Now, the beta of our reference market always has a value of 1. And for convenience, let's just use the S&P 500 as our reference market here, since I think most of you will be familiar with the S&P 500. Okay, but for those who do not know what the S&P 500 is, it is simply an index representing a basket comprising 500 of the largest listed companies in the United States. All right, so the S&P 500 is kind of like the baseline here where all the stocks and the portfolio is going to be compared against when we calculate beta. All right, now let's say we hold a portfolio of stocks and this portfolio has a beta of 1. So what does that mean over here? So that means that your portfolio has an exposure or sensitivity of 1 to the S&P 500. So if the S&P 500 were to move up by 1%, you can expect this portfolio to also move up by 1%. And if the S&P 500 were to move down, right, by 1%, you will also expect this portfolio to move down by 1%. All right. Then what about the case where the portfolio's beta is larger than 1? Then it is riskier than the S&P 500 and even more sensitive to its movements. So if the beta of the portfolio is 2, that means that if the S&P 500 moves 1% in either direction, the portfolio is expected to move twice that magnitude. That means 2% in the same direction that the S&P 500 moves. And finally, if the beta is less than 1, then the portfolio is less risky than the S&P 500 and less exposed to its market movements. So a portfolio that has a beta of 0.5 is only expected to move 0.5%, right, when the S&P 500 moves 1%. All right, so that is essentially how you can interpret beta in this context. So it is a relative risk measure, and it will only make sense when you know what a reference market is. How do we calculate the beta of a stock or a portfolio? Now, this part of the video is going to be for those who are more technically inclined and for people who really wants to know how they can calculate the beta of a stock themselves. Now, if you rather not want to deal with it, feel free to skip this section of the video and then move on to the next one. All right? Okay. Now, you can easily calculate the beta of any stock by doing what we call a simple linear regression of the stock's returns against the reference market's returns. And what is linear regression? So in our simple case here, where we only have 2 variables, one being the stock's returns and the other one being the S&P 500's returns, it is simply a mathematical method that helps you find the best fitted straight line through all these data points here. And beta is then just the slope of this best fitted straight line. So you don't need any special software to actually help you do it. Microsoft Excel, which I think most of you are going to have, is good enough for that. And I'm going to show it to you now how you can do it in Microsoft Excel. In this simple exercise, what we're going to do is to calculate the beta for Apple, then Walmart against the S&P 500. And right on the spreadsheet here, we have about 1 year's worth of daily price data for SPY, okay, which is the S&P 500 ETF, and I'm using that as the reference market. Then we also have the daily price series of Apple and Walmart. And the next step we're going to need to do is to generate the daily return series for each of the security. So let's start with SPY. Okay, let's set the formula equals to today's price divided by the previous day's price and then subtract a 1. And that will give you the daily return of SPY on this particular date itself, which is the 9th of November 2021. So once you generate the formula for this cell, what you can do is just to drag it all the way to the right, okay, to replicate the formula, and then just double click here to replicate the formula all the way down. And now we have the daily return series for all the three securities. And the next thing we need to do is we need to calculate the beta, right? So we go to calculate the beta for Apple stock. Okay, to calculate the beta for Apple stock, you just need to make use of the slope function. Okay, slope open bracket. And you need to supply the first argument as the known y, right? The known y's are your Apple's returns, right? Because you're regressing Apple's returns against S&P 500's returns. Okay, so select the return series for Apple. Okay, then the next thing you need to supply it is the known x, and the known x are your SPY's returns. Okay, select this entire series of returns and then hit and enter. Okay, this gives you a value of 1.26. That means the beta of Apple is 1.26 during this particular 1 year period that we are looking at, right? So Apple is riskier than S&P 500. So that means that for every 1% that the S&P 500 moved, you can expect Apple to move 1.26% in the same direction. Now, what about Walmart? So let's do for Walmart as well. So set in the formula equals to slope, okay, open bracket, supply it with Walmart's daily return series, which is over here. Okay, select the entire series. Then after that, select SPY's return series. Okay, this is what we're doing. We're basically regressing Walmart's return against SPY's return. Okay, hit enter, and this gives you a beta of 0.41. Right, so Walmart, right, being a staple stock, which we do expect it to be less volatile and less risky than the S&P 500. So that means here that for every 1% that the S&P 500 moved, you would expect Walmart to move about 0.41% in the same direction as the S&P 500. Okay? Now, what if we have a portfolio comprising of 50% Apple and 50% Walmart, and we want to know what is the beta of this portfolio? Actually, it is very straightforward, because the beta of a portfolio is just simply the weighted sum of the betas of all its component stocks. So what we need to do here, right, is just to set in the formula equals to 0.5, because we have 50% into Apple, multiplied by the beta of Apple, and add on to it 0.5 times the beta of your Walmart, and this gives us 0.83. So 0.83 is the beta of this particular portfolio in this point in time. So that means that for every 1% the S&P 500 moved, you would expect this portfolio to move 0.83%. Now, if you want a graphical representation or view, right, as to how a regression of beta looks like, so you can look at this particular chart here. So this particular chart is what we call the scatter plot of Apple's return against S&P 500's returns. So the vertical axis represents Apple's returns and the horizontal axis represents the S&P 500 returns. And this dotted red line here is a line generated by linear regression. It basically represents the best fitted straight line you can do to fit through all these data points over here. All right, and the slope, right, of this particular straight line, right, actually represents the beta. Right, so this 1.2572x, right, this is the slope of this particular straight line over here, and this is your beta, right, about 1.26. All right, so this is how you can calculate the beta of a stock in Excel. Of course, you can also find beta of stocks on websites such as Yahoo Finance, but should you want more control over the way you calculate beta, such as deciding on the length of the period to use as well as the data resolution to use, or perhaps you want to calculate the beta of a portfolio, then knowing how to do it yourself is definitely a much more flexible approach. What are the uses of beta? Now, the first thing is straightforward. It tells you how risky your stock or your portfolio is relative to the market, which we already know, right? But aside from knowing how much risk your portfolio has relative to the market itself, beta also tells you the exposure your portfolio has to the market or to the reference market. So this is another way you can look at or interpret beta. So if you want to hedge out the market risk component of a portfolio, what you need to do is to short the beta exposure indicator. So as an example, let's say you have a portfolio which has a beta of 0.5 to the S&P 500. And Right now, this portfolio has a net asset value of $100,000. And what you need to do, right, is to short $50,000 worth of S&P 500 to completely hedge out the market risk component inside this portfolio itself. All right, so this is in a rough idea how you can use beta for hedging. Okay, now beta is also used by hedge funds to construct market neutral portfolios, but this is something that warrants a separate session, and I will likely cover it in a separate video then. Okay. So what do we need to take note of when we talk about beta? Now, the first is that you need to interpret beta in a very specific context. When we talk about US stocks and the S&P 500, they all kind of belong to the same asset class as well as the same market. So we can expect them to be highly correlated, right, to each other, and they tend to move in tandem with each other. So it makes sense here to use beta as a gauge of relative risk. So for example, if a stock has a beta higher than 1, then we can reasonably expect it to be riskier than S&P 500. But if you would apply this to other assets, then it may not make sense. All right. So for example, if you try to find a beta of oil against S&P 500, so you may end up in this case with a low beta of 0.3. But does that mean that oil is less risky than S&P 500? No, not at all, right? In fact, oil is a lot more prone to huge swings, right, and it's more risky than S&P 500 itself. But because oil is a completely different asset class, it has a much lower correlation to S&P 500 as compared to stocks. And as a result of that, oil is much less sensitive to movements in S&P 500. But that doesn't mean it doesn't move, all right? It is sensitive to other things like US dollar strength, interest rate movements, as well as broad movements, right, within the commodity markets itself. So in this instance, right, a beta should be viewed only as a form of exposure or sensitivity to the S&P 500 itself. Second thing, beta can change. Now, a company's beta can change over time as it grows. So a fast and young growing company may exhibit high levels of beta, but once it becomes established, the beta will come down. All right. And a company may also have changes to its business models or financing structure, and that too can lead to changes in beta. Finally, beta is just an estimate. And as with any statistic you derive from the market itself, there will always be uncertainties around the number when you use it to make investment decisions. For example, you may use beta to tell you how much you should hedge, right, in order to desensitize your portfolio to the market itself. However, it is likely you're always going to either overhedge or underhedge your portfolio. It is just a matter of how much. Okay, and these deviations can sometimes have a material impact on your portfolio's performance itself. Okay, that's all for this particular video. I hope you learned something today. And if you like it, do us a favor, hit the like button and subscribe to our channel for more updates in the future. And if you want to know what we do and offer at AllQuant, just pop by our website. The links are in the YouTube description below. Finally, all the best to everyone, and I'll see you in the next video.